All right, so everything that kind of came out on Friday in terms of Russia potentially invading within 48 hours, at least the U.S. telling everybody to get out within 48 hours because of a possible invasion. There was also some chatter about today being an emergency meeting for the Fed. At least that they would do it, not an emergency meeting per se, but at least they would do an emergency rate hike today. That didn't have, neither one of those things happened. Maybe the Russian president there had something going on with his sweetheart on Valentine's Day and wasn't able to do it. But nothing happened. It's a day of, it's a Valentine's Day, and the Olympics are still on. So it's probably a good reason why it hasn't happened yet. Remains to be seen if it will. Obviously, the markets, the bond markets completely reversed what we saw, the down moves and yields that we saw at the end of the day Friday. So very interesting, like the odds for rate hikes are still there. Nothing changed even without the emergency hike as we head into the March meeting. So the market is still full bore headed towards that March meeting. So we're going to talk about today, what the trends look like as we head towards that, and what's driving, what asset classes did well today, what were the big outlying moves in different sectors as well. And then we'll talk about how to trade one of the big bellwethers in that tech area that's been driving a lot of the gains in the market. And we'll talk about how to trade it now. So let's go ahead and get started. Today is Monday, February the 14th, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, let's start off taking a look at the market forecast indicator on the S&P 500. And you can see the down day we had today. We're still not back below that 23% retracement. Remember, retracement starts, in this case, to the upside because we're below the moving average, right? But we're always, you trace back to the mean. That's when you go up, you retrace down to the mean. When you're coming down, you trace up to the mean. So in this case, we're tracing up to the mean, moving average, 30-day moving average. We are back below the 38% retracement, so we're back below that support, but we're not back. So retracements begin when you get, in this case, above the 23% retracement. They end when you either get above the 78% retracement or back below the 23% retracement, and that's not the case today. It's a much smaller range than average, 61 points. So not as bad. The short-term sentiment did fall into bearish levels. More bearish than what we saw there. In fact, it's a lower near-term low after, again, a quasi-bearish near-term high point where you got into the reversal zone, but didn't get above the 90th percentile. And you dropped pretty quickly in a day, and then you're just right out, within a couple of days, you're out of the bullish territory. So relatively bearish, especially whenever you get into now bearish territory on the near-term line. You can see that's what happens when you're in bearish mode. It gets into oversold levels, and of course your momentum line didn't quite get extreme, but it's been oversold too. And immediate line's falling back down, not quite back in the bearish territory yet, but it's falling back down. Market sentiment's falling back down. If you take a look at the Dow Jones, which has been more bullish, its intermediate line's actually still above 50, so it's actually, we still have light pink shading here, but well below the moving average. Not quite 2.5%, but well below that moving average, and you can see also trying to get below that 38% retracement and easily above the 23. So not nearly as, relatively bullish actually on the Dow. Your NASDAQ did get below the 23% retracement yesterday. Not only this intermediate drop, but also the 23% retracement of the big COVID rally. So that means we are, starting a correction, long-term correction there when you're below that 23% line, the orange one. Of course, the intermediate line and market sentiment line are both below 40, so both of these lines are in bearish territory. So we are in a market sentiment decline, according to that, assuming that we go a little bit further, obviously. And short-term sentiment is bearish. And, of course, your Russell 2000 market sentiment's been in the bearish territory. It's actually dipped its toe a little bit below 20 before rising back up a little bit here. Its intermediate line has been rising too, but still in bearish territory. And then your short-term sentiment, again, having gotten up to a higher high, actually, popping down. Now is not a lower low point. So, again, on all these other indexes, you can see we are lower than that midweek low point from last week or early low from last week. So we are lower than that on the NASDAQ. If you even look at the Dow Jones Industrial Average, we're lower than that low point on the Dow Jones Industrial Average. But on the Russell 2000, you notice we are not lower than that low point. So again, kind of shows the relative strength on the Russell on one hand. On the other hand, we are back below the 23% retracement of this drop. We are barely above it to begin with, and we didn't get above the 38%. We didn't get above 30-day moving average. We're back down more than 2.5% below it, and we're still, again, bearish short-term sentiment. So we are, it's kind of a little bit of a flag forming here, and you would expect, if we break out of this flag to the downside, which is, it's a continuation pattern, so you'd expect the downside breakout. You would expect the same move coming down out of that consolidation that you had coming into it. So this drop here, you would expect to be replicated to the downside, down probably towards, 38%, the 38% retracement level and beyond, probably down towards the 50% retracement is ultimately where I think the NASDAQ or the Russell may be headed towards. In fact, I think most of these averages are going to be headed towards that 50% mark of the post-COVID rally by the time this correction is done. All right, let's take a look at the long-term charts, the weekly charts with the Hakinyashis. You can see we're back to a bearish candle on the S&P 500. And remember, the Dow Jones has been more bullish. The PPO has been falling. The Dow Jones has been more bullish, but you notice it also has a bearish candle after a couple quasi-transition candles. The Russell 2000 has been more bullish. It has a couple transition candles. Again, it's kind of stuck here, still easily below moving average, still a negative differential, still a falling PPO. It's actually negative. The others aren't negative yet. The NASDAQ's the closest to getting negative. It's just about there. It's almost crossing the 10-week below the 40-week. And of course, you are below the 40-week. See, you're not below, you're not at least significantly below it. You're just barely below it on the S&P. And your Dow Jones, you're flirting with getting below it too, and just barely getting below that 40-week. But the NASDAQ and especially the Russell are significantly below it. Again, kind of a sign of correction, right, that we are in correction mode. Let's take a look at the 3 green arrow charts. You can see red arrows across the board. We're not getting a red arrow yet on the Qs, and we're not getting on the MACD. We're not getting a red arrow, especially we're not getting it on the IWM. But the histograms are falling. So we are headed in that direction. We do have light pink shading on diamonds. We have light pink shading on the spiders. That means we have three red arrows. When you look at the 2-line version of this chart for the S&P 500, we are below that 200-day moving average and flirting with that point of control. You can see how important it is because if you break that 23% line, you'd be below the 200. Remember, there's stages to this reversal, and just to kind of show you the stages here, IWM price gets below it first, then the 8 and 17 get below it, then the 30 gets below it, and then the 50. And you can see it takes time. From 1126 is when the Russell finally got below the 200 to all the way over here to 120. So it's taken nearly 2 months to get from the initial break of the 200 to the death cross with stages in between, taking 2 months. So SPY would be just starting that, right? Because we haven't had this stage where the 8 and 17 cross. So it would be just starting that. The Qs had that stage of breaking the 200 back here in January 20th. So that's when we got the death cross on the IWM. And then you can see we are just getting the 30 crossing below. So we're still not to the death cross yet. But again, you expect that we will, right? If you expect that we'll continue the stage, especially considering we're back below that 23%. And you'd expect that we'd work our ways down towards 317 at least. Where that long-term Fibonacci support line is, along with the volume node there. Let's take a look at some of these other oscillators. Your S&P 500, you can see, didn't quite get very bullish. Kind of peaked at the high end of this bearish level. Your Russell 2000, same thing. It's not quite as bearish as, say, your NASDAQ, which is back below 40 barely and flirting with getting back below negative 100. If you look at the DMI for SPY, you can see we're back above 30 on the negative index. We're well below 20. The Qs, same thing. We're back above 30. We're back below 20. So we got a directional move going on the Qs. IWM, we are not back above 25 yet, but the positive indicator is back below 20. So your ADX has fallen down. but we're not reversing the trend yet. Your diamonds, you notice, again, as bullish as it had been, the negative indicator back above 30, positive below 20. So we are in bearish directional mode on all these major indexes except for the Russell right now. Your spiders, remember how the trend had ended, so you had the potential for beginnings of a new one. That's not the case in the Qs. The Qs, that trend is still going, and it's very mature. So we're maintaining a very mature trend. IWM is the same thing. As bullish as it's been, it hasn't. We had been so bearish that this consolidation hasn't ended a very mature trend. We're still below -5. We're still above 80. So we still have a very mature trend going, well below the cloud. The red line, the red line, which is today's close, is well below where it was 26 days ago. So very strong moves, even if we don't have a trend going. And you can see we never did really get a significant, we had kind of a quick move here. So we still haven't really got this correction mode started yet on these blue chip index. They would be the last ones. You'd expect the blue chips to be the last ones. You expect the more speculative issues like Bitcoin and ARK investments. Well, you'd expect. Look how long we've been in a bearish trend here. It's insanely strong, below -14 and above 97 or 93. So you can see how strong that trend's been. And then Bitcoin, you can see, had been in a strong trend that's barely ended. And we'll see what happens, with that. Again, kind of a reflection of speculative risk demand. We're about flat over the last 26 days when you look at the price compared to where it was 26 days ago there. Let's take a look at the Bollinger Bands. SPY, you can see we are in the outer half of the bandwidths, in this case the lowest quartile. That's obviously bearish. And that's what you look for trends. 21st percentile there means we're in the lowest quartile. IWM is not, so it's not quite back into that mode yet. And you can see the ADX, the bandwidth is really fallen. So we're back in the squeeze mode here, setting up for a new, break out of it. And the Qs are definitely in the lower half or outer half again. In this case, the lowest quartile, and setting up for a new move, a new bearish leg lower there too, as we come towards the bottom end of the value area of the last year on the Qs. Let's take a look at today's intraday range. There's been some volatility with what's going on in Russia and Ukraine. Obviously, we got a lower high and a lower low. We did not close below last week's low. We did not, which was Friday. We did not close below Friday's low either, the daily low. If you look at IWM, we definitely did. We closed actually above. We closed at the lows on the S&P. We closed above it on the diamonds, kind of sitting right around this 4-week point of control here. And the Qs, you can see we were below the point of control. We did get a lower high and a lower low, but we also closed above the high. So not as bearish, right? Not nearly as bearish of a day, especially when you look at the volume and the trading ranges. I showed you the range was small, 6.25 points. The volume was still above average, 123 million, but lower than what we had seen. So 6.25 points is down here, and 123 million is down here too. So they're both still high numbers, but below the average, but not small enough to break the trend. And remember, you are still we're still in bearish mode. We got a couple bearish moves. We didn't get a bullish move. I saw something that said when you get multiple 1% days, maybe it was on the NASDAQ, you get multiple 1% closes. The last 10 times we've had rallies, even though there we had to look like 4 closes in a row on SPY without a rally. So, we are in bearish mode, and volatility is still pretty high. And you can see the VIX is still up here near 29. It's still up above the neutral area, so it's in bullish territory for volatility, bearish for equities, but it's not quite above 100%. It got up there today above 100. It got up again to 100%, but didn't quite get up to those extreme levels there. So that's something to kind of keep your eye to see if we'll continue to grind our way up there. Here it is on the with its moving averages. And again, everything's trending up. The 8 and 17 are trending up. The MACD is making a new leg higher, stochastics. So we are making it appears that we're making a new leg higher on volatility with the indicators. The question is, of course, how much higher they'll go. But definitely it looks like we are trending to the upside. And I've shown you this chart again. The weekly chart, we just continue to trend to the upside here too. The 30 days about to cross above the 200 week. So we are in this new volatility regime of rising volatility, and you don't. If for us to get back below 20, we'd have to get below all those moving averages again and roll it over, and that's not easy to do as we've seen in the past. So to summarize the technical outlook, obviously the markets were relatively quiet today, but they're still kind of in bearish mode, and obviously we weren't bullish enough to halt that yet today, and not bearish enough to really push us over the edge to that new leg lower, but not bullish enough to reverse the trend either. So the path of least resistance, according to these trend lines, remains to the downside until things change. On a quiet day like this is not enough to change it. On a quiet day like this suggests that it's the path of least resistance is to the downside, and that looks to continue to be the case as we continue to fill in these gaps in moving averages and the long-term moving average, and continue to again, these really, like, the Russell's been in correction mode, deep correction mode, that deeper. The S&P and the NASDAQ are just getting started, so it appears that we're just getting started in this correction as we go from the speculative reopening trades that have been the biggest higher beta plays lately, and now that weakness is transitioning through them large cap, mega cap names. Eventually, you'd expect it would lead into the blue chip names, the Dow Jones type names. So what do you think? Do you agree with that? Do you disagree? Let me know in the comment section below, especially if you disagree. What charts or indicators are you looking at that suggest why you're either a lot more bullish than I am or a lot more bearish than I am? Before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us two things. One, you liked our video today, and two, you want us to do another video again tomorrow. Quick way to give us feedback if you like our stuff. Of course, if you don't like our stuff, you don't have to click on anything. You don't even have to watch. But if you do and you want to let us know, give us a click. Especially, even right now while you're watching, you can just do it here really quick. It goes a long way to helping us get our message, our word out, and get our stuff out to more and more people. So we really appreciate those that do that. Also, while you're down there, comment. What stood out to you from the video today? What questions you have or comments you have about anything I brought up? Post those in the comment section below. Join our website at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. There's my handle at DavidSettle42. And join our Market Outlook Facebook group that we've created. If you're watching us on our blog here, come up, check out some of these other things on the page, including our Market Outlook live video. Click on this image. It takes you to this page. On this page, I do a live video every Monday, Wednesday, and Friday at 3:30 Eastern Time. We look at all the trades and previous market outlooks that I've posted. We talk about whether we should stay in them, get out of them. We talk about how to manage them. We also put on today's trade idea already that you'll hear at the end of the video. We already put it on before the market closed today. We did it here in this class, so you can see all the archives, the previous classes too. They're all done on this page, 3:30 Eastern Time. You can get to it right there. You can also get to it by clicking on Market Outlook Live Trade Review in our main menu. Come down here, you can see our upcoming classes. Click on View More. Takes you to our calendar. You can see all of our upcoming classes and all our recorded classes. Our recordings go back 4 years, so lots of available data for you there on all of our trading rooms here. You can also get to it by clicking on Trading Rooms in our main menu. Come down to the bottom, hit that heart, opens up this tab, hit that like button there. Also click on this thumbs up icon, opens up this tab. Hit that like button. Again, the more you do that, it helps get our content out to more of our followers because of how Twitter and Facebook work. The more engagements, the more they promote it to the people that actually follow us. It also benefits you because Twitter and Facebook promote content in your timelines, specifically from the accounts that you engage with the most. We try to make it really easy for you to engage with us right here, right now, even while you're watching. All right, well, let's take a look at the how things performed today and what's driving the price action. You can see today gold and, it's interesting, gold and commodities were both higher. which makes sense considering, that's kind of the issue right now at hand is geopolitical risk that can really so gold is up there. The commodities do well because Russia's at the crux of this geopolitical risk, so that does well, and then the dollars does well because it's safe haven, right? In this case, from geopolitical safe haven, bonds dropping like a rock, which means yields are rising sharply again. So, and when you take a look at yields here, when you see the strong move higher, that yields the 2-year yield. Remember, is a reflection of the 2-year yield is a reflection of the Fed and their interest rate policies. Remember, this had dropped back down after the here. Let's just go to the 5-day. This had dropped back down here, right after when the news came out that Russia was on their borders, and here on Friday, well, today it's right back up to where it was before that news came out. And then if you look at the 10-year note here, you can see again, not quite at the 2% level that we were. We were above 2% briefly on Friday, got up there the 2.05%. And then you can see going into today, we were flirting with 2% for most of the day today, right now sitting at a little bit below 2%. So there we are right there. So again, well above it on Friday. And then the news hit and we fell back down to about 1.92 and then spent most of the day today back above 2. So again, it's almost as if none of that happened on Friday. And again, that's going to influence interest rate hike odds, and you can see that the interest rate hikes odds for the end of the year continue to be very high for 100 basically for 4 rate hikes. We're looking at 99.8% chance for 4, and then you're looking at 97.4 for 5. You're looking at 86 for 6, and then you're looking at 60% for 7. 7%, 7 or 60, relatively high probability for 7 rate hikes in the next 1, 2, 3, 4, 5, 6, 7 meetings. With, of course, March being the odds here are that you're going to have, you have 100% odds that you'll have 1, and you have 60% odds. It's not quite 100 like it was, but you have 60% odds that you'll have 2. And then, of course, you can see where the odds are for the third one. There's actually quite high odds there that we will get, that we will have the interest rate, that we'll have 3, that will up to that 3 that was a month ago. We had 90% odds of 1, and you can see where we expected to be at. And now we're expected to be at this 50%. For the most part, we're expected to be at this 50% level. So that the bond market has really been pricing in Fed policies and what they're doing, and that was really the biggest mover today, and continues to be a big mover to the downside. Not quite getting below the range on Friday, but still, down 1.25%. So that's the yields. You can see the yield still moving higher, well, above their moving averages there. So TLT would be well below its moving average. IEF, which is more closely tied to the 10-year yield, well below that 8-day moving average. A little bit of a divergence setting up there on the MACD, at least. When you look at the RSI and the CCI, you can see divergences setting up there. There'll be some extreme lows showing here, and then the DMI. If you look at the weekly chart, we are just barely below 30 on the weekly, and the had been below minus 200 on the weekly as well. Needless to say, a very strong trend on long-term bonds, a very mature trend to the downside, and that hasn't changed. Even more so on the SHY, which is obviously a lot more closely tied to Fed rate hike odds, and it's really dropped like a rock to the downside there. Let's take a look at commodities. Remember, commodities also were a big mover today, and when you look at how they are performing, look at that steady grind to the upside. That's about as there's very little up and down. It's been staying above the 8-day moving average and riding that trend. The MACD is about as straight line as it can be because it's not really gaining or losing any momentum. It's just a nice straight line to the upside with good volume here. So nothing's changing. And you look at the dollar, because again, this idea of safe haven, it's up, it's back above all these moving averages. I wouldn't say necessarily it's breaking out because you're still centered on this point of control. You're still below the value area, so we still have some room that we'd have to go up to consider it a breakout, but we are in a leg higher right now. The question is going to be, and really all these moving averages are sitting right on top of each other except for the 200. So it is kind of setting up for some kind of like significant move in either direction. Obviously you expect to fill in gaps, and that's kind of the idea here. Like, we fell down below these moving averages on this little pullback here after the euro made a really strong move up previously. There's the volatility there, and since then we're sitting on the 50% retracement of that bullish move, doing a little bit of a kind of inverse head and shoulders pattern going forward from here. Here's all the different risk asset classes and how they're doing. Safe havens up here at the top, so the dollar, light green shading, green line. You can see gold breaking out like it's doing there. Bonds on a not a free fall, but on the downward trend. But so are equities. Look at equities, VT, global equities, including U.S. equities. Dark pink shading the green line. U.S. equities haven't been so bad, but internationals are all looking relatively poor. Silver is kind of sideways. Copper, remember we had that big breakout. You thought, oh, copper's breaking out. Well, and silver didn't, and we talked about that. And we were like, the fact that they weren't both breaking out suggests that maybe that wasn't such a big deal on copper, and that's been the case. It's not that big of a deal. And we also talked about Bitcoin. You got dark green shading. You're at 65th percentile. You still got a yellow line. We don't have a green line yet, so we're not trending to the upside on Bitcoin. Again, using Bitcoin as a reflection of speculative risk demand. And keep in mind too that you are in a death cross now. The 50, we have gone through all the stages, right? You started with the break below the 200 on 12.9. You finally got this here on 2.4. So it's also has almost been 2 months from to cross these stages, but you are in that death cross. The MACD histogram is falling. The MACD appears to be peaking as we filled in the gap between the 30 and the 50, but unable to really get going any higher. And we'll see if it breaks back below the 17 and the 30, then it will also be breaking back below this 23% retracement and starting a new leg lower to the downside. And that would, again, be a reflection of waning risk appetite, of risk aversion, especially on the high end of a risk scale, because that's where this is, in this high speculative end of that risk scale. Let's take a look at the sector moves, sector rotation chart here. So let's see, let's go to this chart first and just take a look. You can see commodities have just been, or energy, excuse me, has been killing it here lately. Not so much today. It had such a bullish move on Friday. It gave back some of those returns today. You can see your best performing sectors today were your three cyclical sectors, your XLY, XLK, XLC. Even staples did okay along with industrials, and some of your reopening sectors like materials and financials and energy all lagging, including utilities as well, and real estate, some interest rate sensitive areas underperforming with the rise in interest rates, which you would expect would put pressure on utilities and real estate. Should not put pressure on financials though, but financials still really struggling there. Let's take a look at the 12 grid for the different sectors. And there's your cyclical ones at the top, and you can kind of get an idea of why they outperform because they've been so bearish. I mean, dark pink shading and red lines all across the board here, except for materials, but you're pretty close because the intermediate line's rising. You wouldn't expect that it will if we're doing this. Really, the only different ones are financials, which are sideways and not really trending one way or the other, with a high intermediate line, and then energy, which has been so extremely bullish. Otherwise, it's been a very, very broad selling of dark pink shading and red lines all across the board here. All right, now let's take a look at our trade idea of the day. I want to take a look at Microsoft. Microsoft is very similar to the NASDAQ, of course, and it's on its bearish mode too. It's Intermediate lines below 40 again. Market sentiment's almost below 40. Bearish short-term sentiment, 4% below its moving average. Looks like it's consolidated. Looks like it's starting to make a new trend lower to the downside. You can see the bearish after a couple kind of transition candles. We're back to bearish and back and below the 40-week exponential moving average here. If we take a look at the 3 green arrow charts for Microsoft, you can see below the point of control, the flirting with the 200-day moving average again. MACD and stochastics rolling back down to the downside. The Ichimoku cloud is still very strongly bearish, almost back to mature bearish levels again. The DMI is showing a significant bearish trend above 30, back below 20 on the directional movement index. RSI and the CCI are also at lower levels, moving down to the downside. You're looking at the Bollinger bandwidth. We are back in the outer half. We're back in the outer half of the bandwidth, in the lowest quartile, so pushing against, especially with the bandwidth down, looking for a new opportunity to push against that and trend to the downside again. So, things are looking relatively bearish for Microsoft. So what we decided to do here is to come over to the March options, buy the at-the-money put, sell one strike away. So this is what it ends up looking like for a full position size, because we're through the earnings on it. So a little bit less than normal risk for about $1,100 reward if we were to get down. And if it goes up, then you can see like we would have to really break up. So if you go up to for example, if this thing turns around and gets back above, say, the 30-day moving average up into this 311 area, then you notice that that's up here, and we'd be down about half, less than half of our maximum loss. So, for $400 of risk to get almost $1,200 reward, that's a pretty decent reward to risk ratio, knowing where we can get out of it, if it did indeed turn back around. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our forums on our website at marketscholars.com. Open up any new thread in our Market Outlook forum. You have access to it with your free subscription. Reply to anybody else's thread, and let's keep this conversation going amongst the community in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video. Also, you can subscribe to our website at marketscholars.com. Like us on Twitter and Facebook as well. Have a great rest of your Monday night, everybody. I hope you all had a great, happy Valentine's Day, and we'll see you all next time.